Ladies and gentlemen, welcome to the AIC UK Conference 2022. Would you please welcome to the stage the AIC Chair, Elisabeth Scott.
Well, welcome. Someone was reminding me earlier on that the last big face-to-face event that they had been to was the AIC Conference 2 years ago. And how much change has there been since then? And what a joy it is that we can all be in the same room as one another together. So today there are about 300 of us in the room here, and more than 250, I think, on screen, or dialing in on Zoom, or some such thing, attending online. And this is, of course, our first large-scale hybrid event. So please forgive us if things don't go quite to plan. And one example of things not going quite to plan is the fact that Daisy McAndrew, who was meant to be moderating the event, went down with COVID on Friday. And so Catherine Skidmore asked me if I wouldn't mind stepping in. So I'm afraid you're going to see rather more of me on the platform than you might have expected. These are, of course, very uncertain times, with the war in Ukraine, inflation pressing at our doors, energy prices soaring, and a cost of living crisis here in the United Kingdom. Interest rates are rising, and equity markets are falling. So one slightly feels it's not exactly an auspicious time for us to be having this conference. But that does follow a very successful 2021 for investment companies. There was a very positive environment. We had 15 IPOs. We saw strong demand for infrastructure trusts, and some £4 billion were raised in the IPO market for investment companies, along with very strong secondary issuance of some £12 billion. We also saw a number of mergers in 2021, and size and performance, I think, were really the key drivers of those mergers. But it's really good to see boards working hard on behalf of shareholders to improve the environment for them. We've also seen strong VCT fundraising, and we expect to see strong fundraising for VCTs in the run-up to the end of the tax year. And I think it's important to point out that it's not just investors being keen to improve their tax positions, but also to support the contribution that VCTs make to the UK economy by investing in early stage companies. The AIC during 2021 has continued to work on a number of its key areas. In policy, you've seen us doing work on the long-term asset fund and less liquid assets and the ongoing saga of kids. We've issued lots of guidance to members, and if you haven't seen it, I urge you to go to the website and have a look at guidance on things like ESG, for example, and indeed guidance on the US sanctions, on how investment companies should deal with the US sanctions against Chinese military companies, which seems very relevant right now. And on communications, you've seen an enormous amount of coverage of investment companies in the press, picking up on themes such as income, and more recently, of course, inflation. And directors' roundtables have continued to take place virtually through last year, and the good news is that now people can attend in person, which is fantastic. We've had a lot of change at the AIC. Ian Sayers retired as chief executive after a long and successful career at the AIC. And I'm pleased to say that he's actually in the room. I can see him now. He's in the room as a newly appointed member director of an investment company. So congratulations, Ian. It's lovely to have you here with us. And thank you again for all your hard work on behalf of the AIC. During last summer, we did a search for a new chief executive. And I'm very pleased to say that we had a really strong candidate list. Some 40 people put their hats in the ring for the job, from all aspects of our industry. So investment trust people, financial services people, regulators, and people who've worked in government, even one former MP, amazingly. But I'm glad to say that we recruited Richard Stone, who you'll be hearing from just after I finish. And almost 6 months in, Richard and the team have been taking a big look at the AIC strategy, and he's going to talk about that in his presentation later on in his session. Other important things that we're focusing on this year are diversity, and I think many of you will have seen the reports in the FTSE Women Leaders Report review for covering the FTSE 350, which features 71 investment companies, 46 of which have more than 40% women on their boards, which I think is a fantastic evolution since I first joined the industry, or first became a member director in 2011. And only 5 of those 71 companies have fewer than 33% of their board women. So again, fantastic progress. We don't have any published data on ethnic diversity of our boards, but no doubt that is going to come. And we know that this is an area of interest for boards and of interest for regulators, and something that our boards will be taking seriously in the coming months and years. As always, I would refer you to Pathway, which is a fantastic part of the AIC website and is a great area of resource for new and aspiring directors for investment trusts. So if you do have anybody who's thinking of becoming an investment trust director or wants to become an investment trust director, do please point them in the direction of Pathway. Finally, ESG is clearly in all our headlights as board members. And of course, a number of investment companies offer pure exposure to the transition away from conventional energy to renewables. And the sector has seen considerable growth in this regard over the past few years. And many boards are spending a lot of time discussing what ESG means for them. And I suspect we're going to be discussing it even more in the coming months as things play out in Eastern Europe. The AIC is seeking to make sense of the regulation as it emerges and to help member companies explain their policies to shareholders. And it's very important, I feel, and I'm sure many of us feel, that investment companies are operating on a level playing field versus the open-ended funds and other players in the market. So, now, leading on to the main part of the event, really. Today, our theme is engaging investors. And many of us have seen the growth in numbers of individual investors on our share registers, most of whom invest via platforms. And communicating with them directly can be very difficult, when often we don't know who they are, or indeed why they've invested. The AIC did have its first Shareholder Engagement Award in 2021, which was won by Interactive Investor. You'll be hearing from Richard Wilson later on. And I think that that's a sort of great step forward in terms of encouraging people to take encouraging platforms to take shareholder engagement seriously, and particularly thinking about voting, which is so important. So we're hoping to discuss a number of issues and hopefully come up with some solutions to help boards better engage with shareholders in the future. We've got a wonderful group of speakers and panellists with wide expertise, as you'll see from your agenda, which has been carefully compiled by Kath and the AIC events team. A couple of housekeeping points. You've got on your seat one of these. All questions are going to be asked through the digital system, and you'll find a bit of paper that looks like this. So if you haven't yet signed up on your phone so that you can ask questions, please do so. There's a QR code in the conference booklet, and that piece of paper will explain what you need to know. We will be taking questions at the end of most of the sessions, so please do put your questions into the app. And yes, and I hope that that you will participate fully. And now, if I may, I'd like to turn to Richard Stone, who's going to talk to us about his future vision for the AIC. Richard.
Thank you, Elisabeth, and good afternoon, everybody. It's a pleasure to be here. It's a pleasure to see so many people in a room together again. I think, as Elisabeth said, this is our first large sort of in-person event for 2 years, and obviously my first as Chief Executive. So unconventionally, I'd like to just start with a few thanks. Thanks to Elisabeth, particularly for stepping into the breach as far as moderating is concerned. Thank you to Kath and Hazel and the team from the AIC for putting today together. And thank you to Ian, who Elisabeth said is in the audience, for the handover that I very generously received when I started the job back in September. But a particular thank you to all of you. When I joined in September, one of the things I wanted to do was get out and meet as many member directors as I could in relatively short order. I think by the end of the year that numbered several hundred already at various AIC events, albeit a lot of those were virtual. And everybody has given me a warm welcome, and for that I'm very appreciative. For those of you who I haven't yet met, as Elisabeth said, my name is Richard Stone. I joined the AIC in September. Prior to that, I was CEO of the Share Centre, which ran the share.com platform. I was the FD there for 7 years and then the CEO for 7 years. And I had a number of other roles in financial services, ranging from audit through to being an equity research analyst at one time in the years preceding that. And I've joined the AIC at what I think is an extremely exciting time. Although somebody said to me in the conversation I was having over lunch that whenever you join the AIC, it's always an exciting time. When we look back at 2021, as Elisabeth said, you can see here on the chart the record fundraising, capital inflows that we had, nearly 18 billion of capital inflows into the sector, combination of fundraising and asset transfers in, a lot of that in secondary offers and follow-on offers, and the significant blue bar in the middle there of market movement and fundamentally performance in terms of the growth of our assets. The small orange bar is capital returns to shareholders, whether that was wind-ups, or majority of that is actually dividend income being paid out. But you can see that that took our assets under management up to 270 billion, which is a record for the sector. And I know liquidity is an issue that a lot of members talk about, and when you look at the scale of the sector, the scale is increasing. And I got the stats team that David Michael runs for us to put together some statistics for me on the size of our members. And when you look at that, we now have nearly 7% of our members who have more than £2 billion of assets within their fund. A fifth of our members are over £1 billion in size. And if we went back 10 years, that was less than 4%. So you can see how, through a combination of some M&A activity and the capital raising that's going on, the new issues coming into the market, how the sector is scaling up. So it is a time of opportunity, and I think there are, as Elisabeth rightly said, perhaps with all that's going on in the world, it's fair to say there are some challenges out there at the moment for equity markets and investors in general. But for our sector, there are some helpful tailwinds. There's an increased focus on the need to save and invest, and I think the pandemic has made people realise that perhaps their rainy day savings pot needs to be a little larger than they thought it might need to be. At the same time, some people have become accidental savers through that process. There's demand for increased access to a wide range of asset classes, and the investment company sector can provide the vehicle through which to gain access to those. And there's recognition that large pools of capital, in terms of pensions and others, need to access those asset classes in order to deliver the returns for their underlying beneficial holders. And as I put on the slide, investment companies have a track record of delivery in this space, and we can show that through our performance and the returns that we've generated for our shareholders over many, many years. The last point I put on this slide was that technology continues to act as an enabler. And by that I mean, the growth, as Elisabeth said, that we've seen in the number of direct shareholders on register coming through platforms, people investing on their own account, and an increasing interest amongst that audience in investment companies and what we have to offer. Now, it's important to me, obviously, that the AIC reflects the concerns and topics that you as boards and members are talking about. But it's also critical that we have clarity of purpose. And with the support of the executive team at the AIC, the board agreed a new vision and mission for the AIC last week. We don't currently have a vision statement. And so our vision is for closed-ended investment companies to be considered by every investor. Now, this is carefully worded in the sense that it's considered by every investor. We have to be realistic that they might not be suitable for everybody. But they should be part of the discussion. They should be part of the thought process. And it should be every investor. We shouldn't limit our horizons in terms of pension funds and others in terms of whether they're advised or direct. We should be looking to appeal to everybody. So that's the vision. And the mission then behind that, at the moment our mission talked to shareholder value and how we create shareholder value, but didn't really talk to what the AIC did. And so our new mission is to support and promote the long-term benefits of investment companies by engaging with members, investors, and the wider financial community. And that effectively talks to the three things that we do: support, promote, and engage, and the three community or the three groups that we talk to: members, investors, and that wider financial audience. Now, we didn't contrive the support, promote, and engage. If I'd have thought more wisely, I might have come up with a word beginning with G for promote so that we could have had ESG as our three words, but we didn't do that. But as I said, I think this very much talks to what the AIC does. And if we just think about members, and you as member directors largely in the audience for the moment, we support you through our regulatory work, through the information and resources that we provide, through the guidance that we provide to you. We promote you and your companies through our comms work, through the website, and all the PR activity that Annabelle and her team do. And we engage with you through events like today, through newsletters, through roundtables. And important to me as well, we enable you to engage with each other and create that peer group environment amongst yourselves. Now, I was reminded of a quote that vision without execution is just hallucination. I was particularly reminded of this when I went skiing during half term. It was my first ever ski lesson, which at the age of 48 was probably an unwise enterprise. And I had a vision of me coming gracefully down the slopes, which as I fell onto my backside for the umpteenth time wasn't quite how I'd imagined it. And I was also reminded of this last night when I went to hear Tim Peake speak in the New Theatre in Oxford about his journeys into space. And when you're sitting on 900 tons of rocket fuel being propelled at 10 times the speed of a bullet, I think it's fair to say that execution is pretty much everything. Now, we're not shooting for the stars, and this is not rocket science, but what does this mean for the AIC? Well, we'll continue with our regulatory work. I know how much you all value what we do on behalf of the sector and what Guy's team does in terms of our regulatory and policy work. Recently, as Elisabeth said, that's included work on the LTAF, audit reform, diversity, more recently ESG labelling, the ongoing debate around kids, and proxy agencies. I can't do a presentation really without mentioning the proxy agencies, and I had my first call with PERC, who I've reached out to try and build that relationship just last week. We want to be more outward-looking, more visible. I'd like us to be more outward-looking and more visible. We do a lot in this regard already, as I said, Annabelle and her team, and recent press releases have covered everything from the Platinum Jubilee to inflation, ISA millionaires, and even, in a very sensitive way, the dispute in Ukraine, the war with Russia, and the impact that that's having on our sector. I want us to have an increased focus on the long-standing issues of shareholder engagement and liquidity. Those meetings that I had with member directors in my first few months, these were the two topics that repeatedly came up in those conversations, and hence making today about shareholder engagement, engaging investors, was the obvious topic to pick. And in terms of engagement, I think we have, as an association, we need to have a direct role in addressing the retail investor market on your behalf. We need to reach out to groups like the UK Platform Group and to platforms as a whole, whether they're advised or direct. And we need to deal with the pensions market. And you may have seen that we did a recent piece of work with the Pensions Policies Institute looking at the benefit of holding alternative assets within a pension wrapper, and more to the point, by not holding them, the returns that the beneficiaries are potentially missing out on. In terms of specific actions, and you'll see over time, hopefully, us talk a lot more in terms of what we do around support, promote, and engage. In terms of supporting members, I'd like us to produce more guides for you as member directors on topics like ESG. I can imagine when the listing rules come out on diversity, and we're trying to work out how we cover that, where we're in an explained situation, for example, particularly around ethnic diversity, which many of our boards may well be to start with, then some guides around that will be useful. I'd like us to introduce a new director mentor program. Again, on the agenda of diversity, helping new directors coming into the sector and supporting them using our expertise as existing members within the sector to support those new directors as they come on board. And if anybody would like to volunteer for that, please feel free to contact me afterwards. But again, you will hear more about this in due course. In terms of promoting, it's our intention to hold a retail investor event, direct with a retail investor audience and getting fund managers up on the platform to speak to that audience. And we intend to commission an annual report on the sector. We do one already on the VCT sector, talking about effectively a state of the nation, what we add to the economy, all of those things, making the positive case for investment companies without a specific regulatory or other ask within it, but just making the positive case and giving us some collateral to go to policymakers and others with. And we'll be commissioning that during the course of this year. You'll also see substantial changes to our website. Our website is really, really rich in content, and I'm sure many of you visit it on a regular basis. But if you're trying to navigate it and trying to find your way around that content and you're a less experienced user, if I can put it like that, then it's not the easiest of websites to navigate around, partly because there is so much on it. So we need to help the audience to navigate through that content. And we'll be looking to change that and do that. We've appointed an agency to do that for us now. And again, you'll see that hopefully by the end of the summer. And finally, engaging with the platform sector. And as I said, really today is all about engaging investors. is specifically the theme for the afternoon. And coming from a retail platform background myself, I know how important that conversation with investors is. And my one message to you would be, it needs to be part of an ongoing conversation. You need to be thinking as member directors about the different mediums that you can use to get your messages out there. You are marketing yourselves all of the time, and how can you best do that and do that most effectively, particularly when there are intermediaries, platforms and others sitting between you and the end investor. And I hope that you will get a lot out of this afternoon in terms of tips and advice and help in terms of that process. I'm also delighted that this afternoon we've got Henry Curr from The Economist talking to us about inflation. Clearly, when we put together the agenda, we knew that was a rising issue. The current circumstances mean it's probably going to be an even greater issue than we'd perhaps anticipated at the time. And then we're finishing off this afternoon with Nick Robinson from the Today programme. He presented the Today programme this morning, including an amazing interview with a member of the Russian parliament. I don't know quite how he kept his cool or calm during that interview, but was quite amazing. The intention of having him here was really to talk to you about politics and how politicians communicate and what business can learn from politics. I'm very passionate about the fact that I think financial services often talks too much to itself, and there's a lot that we can learn from other sectors and other industries. That was the intention, but obviously with Nick having been in Ukraine recently, I'm sure you'll have lots of questions. He'll have some anecdotes and things to tell us about his more recent experiences. So really it just concludes for me to say again, thank you very much for coming this afternoon. I'm very keen that the AIC remains a highly respected and well thought of and effective organisation. I'm also very keen that we're a very open organisation. I personally want to be as accessible as possible to all of you as member directors. If there are issues you want to raise, concerns you want to raise, if you want me to come and speak to any of your boards, please do get in touch directly with me. I am there for you, representing your association, and that's a very, very important part of what I do and my role. So please do get in touch. Thank you for coming, and I look forward to meeting many of you during the course of the afternoon. Thank you.
Thank you very much, Richard, and I hope you can see from Richard's presentation just why we recruited him to be our new Chief Executive. So thanks very much, Richard, again. I'd now like to invite our panellists for the first panel to join me on the platform. And I know you've all got copies of the biographies of our speakers in your packs, but just to sort of kick off, at the far end we have Holly Mackay, who's Chief Executive of Boring Money, which I feel certain isn't. Well, you perhaps will tell us a bit more about the name when you come to speak, Holly. And then we have Jonathan Gunby, who is the Chief Executive Officer of Transact, and Richard Wilson. Richard Wilson, who's the CEO of Interactive Investor. So welcome all. And I'm going to kick off with a couple of questions, and then I think we're going to have the chance to have some, well, you can all ask questions if you can go on to your app and and think of some. So, welcome. So, Richard, if I might start with you.
Sure.
What are the main trends that you're seeing in investment behaviour, particularly with reference to the demand for investment companies?
Firstly, thank you for inviting me here today. It's great to see a huge turnout. First of all, just two words about us to put things in context. So, Interactive Investor is one of the larger direct-to-consumer platforms with something like 400,000 retail customers with 800 and something thousand accounts between SIPs, SISAs and GIAs, and we process about 1 in 5 UK share trades today. So a reasonable representation in terms of the market. And it depends on which period you're looking at. If I look at the last 3 years, and in terms of investment companies, we've seen the overall share on platform of investment trusts grow from around 10% 3 years ago to around 20% now. So we have about 11 billion pounds of investment trust assets on platform, which is, by those stats up there, it's getting towards, I think, 5% of the industry. And that, in terms of relative performance, that compares to, for example, open-ended funds, which has gone from 17.5% of the same period to 20%. So now we have investment trusts and open funds with exactly the same share. So that gives you a sense of the relative change in those behaviours. Why is that from our point of view? We've always liked the investment company structure in terms of transparency, long-term performance and cost, and dare I say, although I'll be unpopular with some, a relative liquidity. We quite like that structure. The liquidity story has been punted by various other parties I don't subscribe to. I come from the wholesale markets. I think that's all made up. In absolute terms, liquidity is always a thing, but relatively speaking, we quite like the investment trusts from that point of view. More recently, as the two major forces of change keep coming, which one is technology, and that's both disrupting the costs to invest in a positive way, so it's making it more accessible to more, and that is increasing competition, broadening the audience, that's a positive, as well as the tools themselves making investing less confusing and fraught. We have an ongoing challenge. We may be, relative to others, better at this than some, but every day is a fraught day at trying to make those journeys better, simpler, and the outcomes for more consumers better, because you are attracting more people who are less sophisticated as you broaden the audience. So part of our job is to make it simple for more. And what you see is, in terms of behaviours, is there's the intuitive and the counterintuitive. So the myth that younger people will invest in sexy stocks and be risky irrational. The facts are, for our 18 to 24-year-old customers, the three largest holdings they have in aggregate are investment trusts. So you see some of those facts which are quite compelling, and also the myth about, I don't know which side of the trade you're on between genders, but the myth that there's somehow a performance difference between genders is simply not true either. So we're at a sufficient scale where what we're seeing is a continued growth in appetite for collectives and specifically investment trusts. We've been very careful in terms of our rated lists and our research and our content, always to try and ensure that we are impartial. And so we give equal weight. We're style agnostic, and we give equal weight between open and closed funds. And it's interesting that that's drawn equal sort of representation of investment trusts on our platform, when relative to the total size of the industry, the fund industry obviously is that much larger. So that's what we see. We also see a great ongoing increase in expectation from the consumer in terms of service and outcomes, which is kind of the day job. We are a service business at the end of the day.
Thank you. And Jonathan, are you seeing something similar?
Well, obviously we play in a different
Absolutely.
way. So it is a little different. So we are UK only, advisor only. So we have about 6,000 IFAs that support Transact by placing clients' money and investments on the platform. We offer a wide range of wrappers, so pensions, ISAs, everything you would expect. And we don't influence the investment decisions at all. So we are totally agnostic. We are just executing what the advisor or the discretionary investment manager, which have become increasingly important. We execute what we're told to execute. I think the percentage split between various vehicles has been remarkably consistent. So investment trusts, for example, are less than 5% of the 50 billion on our platform, and that percentage has been very consistent over the last 10 years. VCTs have grown a bit, and there's a reason for that I'll come on to, but VCTs would be less than 1% of the platform. Now, of the 6,000 advisors that use Transact, it's only about a quarter that are using those vehicles. So, you know, that speaks to me that there's probably an education and promotion objective that, you know, you might want to consider to reach out to more advisors. We're collaborative. You know, Richard reached out to me a few weeks back, and we've already arranged for Richard to come to the UK PG. We've sort of facilitated that. We're very happy to have conversations with you know, yourselves. And a very good example was on VCTs, where the rules were changed just a few years back, where a nominee could invest in a VCT, but still arrange via your administrators to issue share certificates to the underlying investor. And that was very difficult until the rules were changed. And we actually hosted a little working party at our office of a few VCT providers, any that wanted to come, and we redesigned the process to facilitate that. So that has resulted in some increases in new subscriptions to VCTs. We're very comfortable handling IPOs. We've handled hundreds over the 20 years that we've been in business. The other trends that I think are important to be aware of is the increasing importance of model portfolios, or templates as we call them on Transact. So when I look at all of the assets on Transact, it's just under half that are in a template. But when I look at new flows, it's nearer 70% that's actually in a template. So actually, if your product is inside a template, obviously that's very, very helpful. Increasingly, it's still it's less than half, but the discretionary investment managers, the third-party discretionary investment managers, continue to get stronger. And we've seen that over the last 5 years, quite a big increase in discretionary investment managers. So clearly, a relationship with a third-party DIM actually means you can have a relationship with many, many IFAs that use that particular DIM. If anyone wants to talk to us about how templates work, they can get quite complicated, and the design of the functionality is important, particularly when you get things like fund suspensions. To have the ability to rebalance around any suspended funds becomes extremely important. So if anyone wants to talk to us about the mechanics of VCTs or other vehicles, very happy to do that.
Thank you, Jonathan. And Holly, from your perspective, investment companies are they a growing part of what you're talking to people about?
Thank you. And for those of you not familiar with Boring Money, it's a website I set up about 5 years ago to help consumers make better choices when it comes to their long-term savings. So we have a comparison site which helps people to pick an ISA or a pension, but we also do a lot of content, a lot of education. In terms more broadly of what we're seeing in the market at the moment, people are nervous at the moment, obviously, they want help. So we've had nearly 100,000 people on our site in the last week looking for content, sort of looking for reassurance. It's about in line with what we'd expect to see. We still see that surge at the end of the tax year. That does sort of definitely still have an impact of people saying, right, I need to sort my ISA out, I need to sort a pension out. In a way, what we see is similar to what Jonathan was talking about. When people come onto our Best Buy tables, we do help them to filter. And one of the ways we help them to filter is to say, are you a confident investor? Are you a DIY investor and you want to assemble your own thing? Or do you want a ready-made option? Do you want that ready meal where someone else has done it for you? And about 68% of people pick that ready meal option. So they're saying, I don't actually want to assemble my own portfolio. I don't know what I'm doing. For God's sakes, just get someone else to do it for me. Where do investment trusts sit at the moment? They are in our universe still quite niche. They are still for the more confident, typically for the older, typically for the more affluent type of investor. you know, I think that trend towards ready package solutions is only going to increase, because what we certainly saw over 2020 and 2021 is the profile of what is a DIY investor changed dramatically. If you'd asked me about 6 or 7 years ago, it was retired colonels in Surrey who went to the local golf club and drove a Range Rover. It really was. Like now, if you look at how 2020, 2021 changed the market, you know, 21% of all investors in the UK have been investors for less than 3 years. Now think about what they've learned think about the environment over those 3 years. They've basically been in a bull market where tech stocks have done very well. You know, so that's a very different type of investor to investors that have been through sort of crashes and different market cycles. So I think the need is there for investment trusts to say to people who do want to learn and to take a platform like Interactive Investor and start to assemble their own portfolio, here's who we are and this is what we do. Because as a content writer, you guys are more complicated to try and explain to a retail customer than a fund. You know, when premiums, discounts, gearings. So I think that sort of need to really sort of think about that content and how you position yourselves in the sphere of choice is important.
Thank you. So just looking at some questions. Richard, platforms make higher commissions or pay higher commissions on open-ended funds than investment trusts. Is there therefore an inbuilt incentive for the platforms to push open-ended funds?
That's a great question, because we don't. Who loaded those questions? So we're
the most voted.
So as an example, so we charge you £10 a month. You get a free trade, and then we charge you either £3.99 or £7.99 to trade, irrespective of whether it's a equity or a open or closed fund. Some of the other platforms that remain nameless, Hargreaves and AJ Bell, for example, so they're great businesses, and of course they do a great service. But Hargreaves, for example, they'll charge you 45 basis points to manage to support an open-ended fund, and they make 45 quid off a year off investment trust. So it's something like a 10 times difference in incentives. That obviously doesn't influence their behaviour at all, clearly, but it will obviously beg the question just because of the economics of it. So, I mean, back to where the world's going is the world's clearly going where that sort of, and our proposition is just about trying to support transparency, choice, and a level playing field so that the consumer make the choice that's right for them without questioning or having doubts about why they're being presented with certain solutions. And clearly any change in difference in incentive immediately raises that doubt, which for me is not healthy. So we don't do it. We're fortunate we've been able to grow substantially over the last few years and have a reasonable chunk of the marketplace. Obviously we remain quite ambitious, but we'll always remain, and some of you will be aware that there's a potential transaction with a firm with very few vowels. But that will change nothing in terms of our basic proposition, which is an impartial subscription business that provides open architecture solutions.
Thank you. And Jonathan, the advisor market, you were talking about model portfolios. Do you see there being a place for investment companies on those model portfolios? I mean, do you have any ideas about how investment company boards can, get their investment company on those model portfolios, and what can we do to sort of bring that about?
I mean, you definitely can. So many of our templates do hold not VCTs but investment trusts, and but there's lots that don't. Infrastructure, I've noticed, is particularly popular, for example, in these. It's about education. It's back to Holly's point, because even if the advisor understands the investment trust and how it operates, they've got to explain it to the client. So they've got to explain the discounts and the gearing, etc. So I think it's actually making the advisors confident to explain to their clients is really crucial. As I say, the percentage has not changed over the years that's in investment trusts. So clearly I think there's an education need for advisors. We don't have best buy lists or anything like that. We don't make recommendations. We do, however, for all assets on our platform, we actually communicate with the fund manager on open-ended, the investment company, who are the advisors that are placing trades, buys and sells. So we issue that monthly. So even though it's invested through a nominee, you know exactly who the underlying firms are. So we're very happy to share that. So it really is engage, and it's particularly educating the advisors to grow the market.
And do you think advisors are open to that, or are there just some advisors who just say, it's never going to be for me?
No, I think they're very open-minded, and we do see new propositions come along, and they'll consider that. The VCT subscription is a good example. You know, if you explain to them how it works and educate them, they're open-minded. I mean, they like something to talk about to their clients. So if you make them look fantastic in front of their client, you'll be their friend, you know, etc. And as I say, we work with all firms to say, actually, the administration on investment companies works very well. It's the VCTs that are a bit more complicated for new subscriptions. But we're happy to work with you to make the mechanics work effectively. But the communication, education, down to you, I'm afraid.
Thank you. And Holly, Richard made the point earlier about the young buying investment companies, which might, as he rightly pointed out, I think might be slightly counterintuitive. What do you see when you're looking at the questions people are asking, or the people who are searching for information about their investments? How active are the younger people in the market?
I don't think you can categorise any more by age, because they're just not. It's not a. One point I'd make is investors is no longer a homogenous term. So we see people on our site who are in their early 20s, who are super savvy, want to read up. We see people who are extremely affluent in their mid to late 50s and have got no clue where to start or what they're doing. So I don't think age is particularly helpful. What I do think is helpful is a point that sort of Jonathan said is how do you give the advisors something to talk about? How do you give them a nugget? And I think, across the industry, this is not an industry that is a fan of the executive summary, okay? So if we talk to people about better engagement, a lot of people will sort of instantly go, well, how can I keep that 80-page PDF? And if you're telling me I've got to make it shorter, can I use font size 2, please? What we need to do when we think about how to engage people, I think if we're really honest with ourselves, is that what you're talking about in your boardrooms? Or are you saying, how can we force people to listen to what we want to tell them? Because it's a very different conversation. And the best marketing and the best engagement, I think, comes from when people take one very specific example or a story, and you see this with I've seen it at endless sort of conferences with IFAs there. They like it when the asset manager is talking about one particular component part of the portfolio or creating a story. Now, particularly when we're talking about sort of ESG and how we might communicate that, when we sort of talk to end investors about what they want to know, they just want to see a few examples initially. And I think that's the layer that's missing, because what you guys need to do, I think, is to get people to say, I'm going to go home tonight and on a desktop or on a laptop, I'm going to give them 10 minutes of my time and read all that really good, rich content that you have. But what's missing is that sort of bit on the top, that little nugget, just that they'll see on a mobile. And reading investment content, try it on a mobile. I read everything on a mobile now because you go, oh my God, I've got to change how I write. So I think it's sort of getting better at the little nugget. It's like the Amazon ads on telly I see at the moment. They're trying to sort of big themselves up about sustainability. They don't try and tell everybody everything they're doing. They've shown one member of their sort of team in one corner of England doing one specific thing, but they tell a nice story about it. And that's what I think's missing.
Which is why we're all here today, talking about engaging shareholders. Just following on from that point, one of the things that we as boards all would love to see is more shareholder participation in terms of voting. Now, Richard, obviously as the winner of the Shareholder Engagement Award, the inaugural Shareholder Engagement Award, I mean, you've clearly made a big effort and made a lot of steps in that regard. Do you want to talk a little bit about that? And then I'll ask Jonathan to talk about how it can work through the project.
Sure, but we're pretty modest in terms of what we actually do compared to what you'd expect. I mean, when we've been working with the FCA, we've worked with the Law Commission, we've been working with HM Treasury on just trying to pursue a very simple objective, which is create transparency, choice, and a level playing field. And the voting thing is just part of that picture, is how do you engage the consumer with their holdings. I mean, our particular actions that we took, I mean, we've got the progressive advantage of scale where the cost of doing something marginally gets lower, so the cost of providing free voting to everybody, obviously for some smaller firms, would hurt a lot. For us, relatively speaking, it didn't hurt that much. And the compliance thing, which said, actually, you can't really auto-opt people into voting, you need to ask them. We ignored that and just switched everybody on. A few complained, as you would, but can we regard that as an obligation because we're acting as a custodian, we need to inform the members of their voting opportunity. So for us, it's just creating that engagement dialogue between the consumer and the holdings, because ultimately that benefits everybody. And of course, I mean, not being completely altruistic, it benefits us. If we're unable to communicate with our customers, that doesn't help us or them. So for us, it was a very sensible, natural thing to do. And the fact that we've focused on that is just because we keep coming back to what our themes are of what projects choice, what creates greater transparency, and how do we create a more level playing field. We know, for example, that in the UK, something like 10%, and we're over-indexed, obviously, but something like 10% of retail shareholders use their voting rights, and institutions, it's somewhere between 80 and 90. That statistic is ridiculous. So our job is how do you move the dial so that you can create a more engaged outcome. That means making it easier, because when I'm an example of self, if I've got to go and hunt through a website to vote, it's on my top 50 things to do that day. It might get to number 35 and it won't happen. So it's got to be easy. The language chosen has to be languages accessible. In fact, you're probably as guilty as anybody of having voting agendas and a language used which is some sort of strangulated Latin, which disenfranchises most of the consumers before they start. So there's a whole kind of process required of making it intuitive and easy to get to the point and know who your audience is. I mean, to Holly, to your point, if you're not, I don't know who here does YouTube content, who pitches their investment trust to their own children and doesn't get the immediate glaze over. I've got 4 kids and that's quite a high bar. Uses language that is mobile friendly, that actually can get to the point whilst being balanced. They're not easy things to do, but if you're not engaged in that, and they're really hard to do, if you're not engaged in doing that, then you're going to struggle to be relevant tomorrow, because everyone expects to be engaged in a multimedia way, in language they understand, and be very clear about what actions expected of them, because everyone's time starved and is flooded with inbound information. They're trying to cherry pick through what do I care about and what do I need to do.
Thank you. And Jonathan, just thinking about the advisors that are your clients, I mean, how do they approach voting?
Yeah. So probably worth just explaining a bit more about our legal model and operating model. So our contractual client is Mrs. Miggins. It is the end customer. So if you can imagine, that's our contractual client, and we link the advisor to the platform. To give you a feel for the type of customer we have, because I think it sort of gives some context, the average individual, if you divide it and look at it simplistically, the average individual investment's 250,000 in a portfolio. But you get lots of mum, dads and children. So if we look at it by family, it's something like 450,000. So that's the type of customer we're dealing with. Interestingly, mum and dad often aren't very engaged at all. We can see from the logins, and actually the children who have got small holdings are much more engaged, which is interesting. But all of those have come to us via an advisor. So our main communications are with the advisor, and in fact, we've switched off paper for almost all customers, but we still send a lot of things online to what we call their pickup page behind a secure login. I have to tell you, we get lots of requests to say, please don't send any more things to my pickup page. This is from Mrs. Miggins. I've got an advisor, that's why I pay the advisor. I'm not interested in this stuff. So even things like contract notes, they're saying, can we turn them off? We say, no, you have to get those. There's certain things we have to send to you. So the end customer would like less rather than more. So that's one of the things one's battling against. Now the advisors, we talk to them all the time, of course. They're very engaged with the websites for the investment companies themselves. So they're getting their information from the fund managers, the investment companies, etc. So our approach is that we don't automatically send out corporate actions, notifications of corporate actions. We do in some circumstances. So we've got a bit of a list of those that we do and we don't. But just to give you an example, just because it was one the other week, a delisting, for example, if there's a delisting coming up, we would notify people of that. If it's a name change or something like that, then we wouldn't. So we're quite selective. We've had no requests from advisors for more notifications of corporate actions. So from where we sit, we're just not seeing the demand for this.
And Holly, from your perspective, do you think that voting is something that the people that are on your platform or are on your website are value? Do you think it's something that they want?
Yeah, we researched this last year. We went to about 6,000 investors and 32% said, yes, I am interested. Now, this is, when you research people about what they would do, it's the best version of themselves that answers. So I think that's possibly slightly overinflated. It all comes down to friction, as Richard was saying, and removing friction. So I would start, I think if you look at what is more likely to engage people at the moment, there'll be core issues related to ESG. That's where I would sort of start to test, pick your battles. If you're going to sort of go in and ask for engagement, pick a topic which you know people are talking about down the pub anyway, but you can't achieve it without removing friction. So that's where it is got to be a sort of collaborative effort and involve the platforms, because without that it won't succeed. And I think this is, something I'd say as you're discussing engagement today, you're effectively talking about how to become retailers. And if you think about a group like Sainsbury's, how much time do they spend on thinking about the ingredients of their Taste the Difference range compared to how much time they spend understanding you, emailing you, customizing what they do to you? It's expensive and difficult to be a retailer, and it requires a real shift in how your business operates and spends its money. To do that, you can't just grandly open the doors to the institutional warehouse, to the proletariat, and sort of welcome them in. It's a very difficult and expensive sort of mind shift. So I think it's something that can't just be done. Marketing is and has been an afterthought, I think, in the industry, and that's going to have to change if groups really want to address a retail audience.
If I may on that, I mean, part of what the platform should be doing is providing a conditioned shopfront, to pursue that metaphor a bit further. But we don't control the content. That's really down to you. And it's about addressing not your audience just for today, but 5-10 years ahead, because we're all making best guess about what that will look and feel like as we go forward. So it really is incumbent upon all those who are trying to engage with the audience to take a view of that and create that content which resonates, which has got to have a clear purpose, it's got to have a clear message and clear performance, And in a congested space where you're fighting for eyeballs and for decisions, it has to be done in a very clean, crisp, and high quality way to get that audience over. So when our job is to present it, your job is to create it. We do have, by the way, a brand new media room just over the road. If you fancy using that, just rock over and it's yours.
Yeah. Sorry, if I could just add as well. I mean, if advisors ask us to vote on something, then we will. So again, as Richard said, it's really for you to communicate thoroughly with the advisors, and then they'll decide and instruct us if they want us to vote.
So just coming back to Holly's point about how we communicate with shareholders and the sort of the single nugget of information that's going to pop up on your phone. Have you got a sort of magic recipe that you could share with us?
Well, I don't know if it's magic. I mean, it's taken 5 years and a lot of money to sort of test, and we're still doing this. I think, for it's understanding your audience, and from our perspective, from our readers, I think there's probably two broad camps when it comes to sort of investment trusts. There's either people who are looking for joyfully and reassuringly boring, or there's people who are looking for a bit of spice and perhaps gone down more of a sort of thematic play. What is it? I mean, it'd be very different if you asked me if I were running a technology trust. The nuggets I'd be pulling out now would be sort of quite stock specific and addressing concerns people have about what's going on there. That's going to be very different from people who are sort of income seekers, older, traditional, sort of more experienced investors who are more likely to have a more measured view. But I think it is, all of you will know far more about there'll be people in this room who know more about mining than the average person would ever want to know, for example. So just be realistic about who your audience is, what's their attention span, as Richard thinks. And I would, what are the 3 bullet points? If you sort of had to talk to someone at a party and your aim was not for them to run away screaming, what would be the 3 things about your trust that you think are genuinely really interesting things that people would pick up and talk about? And just try an exercise where you just talk about, limit yourself to 3 bullet points. What are they? And just test stuff and test engagement, because what do you want your investors to know about your trust? What's your kind of real call to action there? Less is definitely more. And then once you've got the 3 bullet points, design them up so people could read them on a mobile screen without having to swipe down.
Thank you. So once we've taken Holly's advice, how are we then going to convey it to the ultimate shareholder either through the Transact platform or indeed through the Interactive Investor one? Is it possible? So,
I mean, we send communications electronically to both the consumer and the advisor, so they can, they have to log in. It's all secure, and that's how they pick up lots of information that way. Now, in truth, many of the investors don't log in very much. I mean, some hardly ever log in, and we can see what they do when they log in, and they go to the valuation page, and they look at the graph of how it's done over time, and that's about the extent of it. The advisors behave completely differently, and they can download lots of things on an aggregated basis. So, for example, when we've had fund suspensions back to managed funds for the moment, over recent weeks, they can see very quickly online what are my 30, 40 clients that have been affected by this holding. So we do, all of our communication is through the secure portal.
Great.
Well, I think, and I'm probably going to stand corrected here, but I think any bit of content that you produce for your company, we will project to make it available to all of our customers, number one. So that's on a pull basis, and on a push basis, on a push basis, we have a bit of AI that knows what you hold, it knows what your preferences are, and knows what people like you do and whether you liked it or not. So then it will push content to you, which has got a probability of X of being something that you'll be interested in, and then we know whether what you did with it, whether you read it again, how long you spent reading it, whether you liked it, didn't like it, whether you didn't trade it, and depending on what you did with it, will then either show you similar stuff again or not. So the message there is if you're not clear what your proposition is, your ability to, and you're not clear what your differentiation is, your ability to target a consumer that's actually interested in what you might be interested in your product will drop. If they're already a holder, then they'll get everything. If they're not a holder, and you're fuzzy on what your kind of differentiation and your proposition is, the hit rate will just go down. And that's just the world that we're in now, is you need to be very clear who you're trying to get to, because that function of ours is a matching technology. It matches demand with supply.
And if I might, on that, what's I think helpful is don't differentiate yourself in terms of perhaps how you in the boardroom would do it. It's in terms of how your customers would see it and how the end readers will see it. And ESG is a great example of that. I've worked with some asset managers on content.
Yep.
And they spend an awful lot of time telling me how bad everybody else is at it and how ESG's been in their DNA since 1066. But I'm like, no, actually, I know that this is what this group of people reading this content care about. So could you please redefine and re-articulate that USP in a way that's going to talk to that?
And to your point earlier, I love this stuff. To
Are
your
we
point
agreeing
earlier,
with each other?
Oh,
Richard?
there's always an
very
exception to the rule.
unusual.
Is that some back to some myths and not being ageist. There's some kind of general presumptions that you go through different life stages which drive your behaviour interest. From our experience on platform, that's simply not true. You have, back to you saying, the younger, very discerning, thoughtful investor with a low risk appetite who's sustainably driven. That's the fact they're young is just an attribute. It doesn't describe it's just part of that behavior set. So look at it holistic about what you're offering to a broad range of demographics and then learn from experience.
Well, one thing I've observed over the last year, which I'm sure is a result of the pandemic, we do lots of co-browsing with advisors. So, often showing, so we're screen sharing and we're navigating around and helping the advisor. And we've had lots of requests from advisors if they could use the same technology with their customers. Because they're saying it's much easier. This is a great way to communicate. I would like to do the same with my end customers. The first time I had this request, I sort of dismissed it, and now I've had it quite a lot. So it's obviously there's a really clear trend there. The other thing I would say is going back to templates and going back to the increased usage of those. It means that the advisor, it makes the communication easier because they're tracking, let's say they're tracking 40 holdings that they've got in that particular template. They create a communication piece and they can communicate with a whole range of clients that are invested in that particular template. So that's another interesting facet.
So getting investment companies onto those templates is absolutely...
It's key. It is key. It is.
Great.
Yeah.
Well, listen, I see we've got no seconds left for this. I'd like to thank you all so much for such an interesting and insightful discussion. I've certainly learnt a great deal about how you function. I think that I've got a lot of tips about how to write the marketing propositions for the investment companies in which I'm on the board, and I'm sure that everybody else will join me in thanking you all for joining us today. Thanks, Holly. Thank you very much, Jonathan. Find my programme. So I am delighted to welcome Henry Curr onto the stage now. Henry, if you'd like to come and join me, you could get to stand here. Henry is the economics editor of The Economist, and I gather from Kath that she got the latest update of his slides at 5 o'clock yesterday afternoon. So, which I think only goes to show how quickly the world is changing. The world around us is changing. So, Henry, over to you, and then we'll have questions at the end.
Thank you very much. It's a great pleasure to be here today. It's a great pleasure to be doing an in-person event once again. Although I must say I've never before agreed a title for a speech, only for that title to be somewhat overtaken by events in the 2 or 3 weeks since I agreed it. It's very clear from what's happened in commodity markets over the past 2 weeks since Russia invaded Ukraine that the world economy is facing a profound commodities price shock. That's what I've been writing about this morning. It's what you'll all be reading about over the coming days and weeks, I'm sure. So the answer to the question, will inflation subside, is in light of that, not anytime soon, especially in Europe. And perhaps the question I'm going to have to try to answer instead is how bad are things going to get and how persistent is the problem going to be? When thinking about the rates of inflation we're likely to face this year, the natural point of comparison is the 1970s and the 1980s. Those decades loom very large in everyone's imagination. And looking back at those decades in the history book, it's clear that high inflation and politicians and monetarists, economists fighting against high inflation in many respects defined those eras. This inflation problem that we're facing right now coming out of the pandemic and with the war in Ukraine is a bit different. I think it's going to get somewhat lost in the history books compared to the fight for freedom that is taking place now. And in fact, I even wonder whether the COVID-19 pandemic is going to get somewhat lost in the history books to that war in Ukraine, much as the Spanish flu got lost somewhat in the history books to World War I, and inflation is certainly going to seem insignificant by comparison to that. But of course, we are facing seismic economic events, as well as seismic military, geopolitical, and humanitarian ones. We can't get away from that, and my task today is to think through those economics. And one way in which history is echoing is that the inflationary shock we're going to see from these expensive commodity prices is going to be layered on top of an existing problem with inflation. Just as in 1973, the inflation shock from the oil embargo and the Yom Kippur War came at a time when inflation had already been rising in the world economy and propelled it to much greater heights and caused an even bigger problem. Now, I don't know if it's a relief to hear that I'm not going to try to make too many precise predictions. As you may have noticed, the recent record of inflation forecasters isn't very good. But I'm hopefully going to offer you a framework for how to think about where inflation is going to go next. I'm going to try and boil down the issues that are in play. And doing that requires a bite of two apples. It requires understanding how we got to where we were 2 or 3 weeks ago with the existing high inflation problem when I agreed the title for this speech, when I made the first draft of my slides, and then understanding what the consequences of the commodities crisis is going to be. So let's start with how we got to where we were 2 weeks ago. And if you'll forgive me a little bit of advertising, here is the story told through covers of The Economist magazine. When the pandemic first struck, it was quite clearly something that reduced inflation in the economy. It killed confidence, it killed spending overnight. So governments felt very secure in spending abundantly on economic support programs like the furlough scheme, like the cash handouts you had in America. And they ended up unleashing this vast wall of stimulus, $11 trillion globally, much of it matched by the trillions of dollars bought by central banks like the Bank of England to help finance that fiscal stimulus, not that they would admit it. And in the summer of 2020, it seemed as if we'd sort of reached this new era of free money in which government budget constraints didn't matter, we'd learned that debt didn't matter, inflation would never be a concern again. But pretty soon at the end of 2020, monetarists began to warn about the inflationary consequences of the money supply from all this stimulus going through the roof. Then President Joe Biden was elected, and he signed an enormous $1.9 trillion stimulus in America, even as it was becoming clear that the economic recovery from the pandemic and in labor markets was pretty rapid, it was pretty V-shaped. Then, as America boomed back, the world's supply chains got bunged up, they got overwhelmed, and the world economy began to be characterized by shortages. Shortages of goods, shortages of labor, shortages of fuel, even shortages of housing. Then, at the end of 2021, central banks began to react to that. They they had to change course and quite quickly turn to a program of tightening monetary policy. They became very worried about the prospect of a 1970s style wage price spiral. And the question became all of a sudden not that will inflation ever return? It became, are central banks behind the curve? Are they on top of the problem here? And how much will they have to do to stop things from getting completely out of control? Now that story is quite intuitive, rolls off the tongue. It's easy to tell how we progress from one phase to the next of it, the next phase, sorry. But although that seems easy in hindsight, the subtleties matter quite a lot for understanding how we have reached the moment of high inflation and what's going to come next. So, for example, you will have read a lot, I'm sure, during the pandemic of the inflation that's been brought about by the world's so-called disrupted supply chains and how the vulnerabilities of an overstretched model of globalization have been exposed by the crisis. And I always find this a little ironic because supply chains are not among those bits of the world economy that were most disrupted by the pandemic. The most disrupted bits of the world economy over the past few years have been those non-tradable, really local things, hairdressers, cinemas, the restaurants you couldn't go to for a long time. And if you think about some of what supply chains have managed to deliver during the pandemic, it's been pretty impressive. The rapid provision of COVID tests to the world, for example, and much of it coming from South Korea, wouldn't have happened without the model of globalization that we have. And it's really hard to imagine that if governments had insisted on nearshoring supply chains for COVID tests, that we would have got to the point where we can all go and order abundant free COVID tests online. And I think we would have been worse off. So why have supply chains been bunged up, even though in some senses they performed well? Why have they been a source of inflation? Well, the real cause, much more important than the supply disruptions attributed to lockdowns and the pandemic, has been a shift in consumer demand away from spending on those disrupted services I spoke about and towards spending on goods instead. And that, combined with the really strong support for household incomes, has meant that there's been tremendous demand for goods. And this is what I show here. So this shows America on the left-hand side and Britain on the right. And it's showing the share of consumer spending going to goods in the yellowy orange and services respectively, normalized in each case to 100 for the start of 2019. And you can see that those shares were normally pretty stable. Consumers spent on goods and services in a predictable manner. And then they went crazy during the pandemic. People bought homeware, they bought furniture, they bought office equipment, they bought computers, cars, and so on, instead of spending out and about at restaurants and the like. Now, everyone's got their own story during the pandemic of their ill-fated purchases of sports equipment, home gyms, and so on. I'm sure there are plenty in this room. Personally, it's a bit hard for me to judge. I became a father during the pandemic, so the number of toys in my house certainly made me feel like I was personally responsible for too much world goods demand. But I know that this was an economy-wide story, and I also found that it became increasingly common when I was interviewing sources to discover that they were talking to me from atop their newly bought Peloton bike. I expect lots of those are now in the tip or on eBay. These charts, in my opinion, show the single most important driver of the inflation that took off in 2021. That shift to goods spending overwhelmed the world economy's capacity to supply goods, and in so doing, it inverted an established truth about the world that had held for decades in the era of globalization, certainly since China joined the World Trade Organization, and that is that goods prices go down while services prices go up. People used to argue that relentless supply of ever cheaper goods from the poor economies of Asia had kept inflation lower than anyone wanted it to be in the 2010s. I remember because in 2019 I wrote a whole special report in The Economist about whether inflation had gone away, which I know in hindsight now looks like one of those contrarian magazine covers that you should bet against. It's a dynamic that's fundamentally been broken over the past 2 years. Now, as you can see, it's partly unwound in Britain, or mostly unwound even, and that's related to the fact that we've thrown off the COVID restrictions relatively fast. But it hasn't yet unwound in the US, and in fact, it went slightly the other way in January, as you can see with the Omicron wave there. And that matters the most because the US is the country that supported household incomes the most through that enormous Biden stimulus that I mentioned earlier. There's this famous phrase that was used in America in the 1990s, debate over free trade, saying that people could hear the so-called giant sucking sound of free trade taking jobs overseas. Well, during the pandemic, I think there's been a giant sucking sound as America pulled in all these goods, making them more expensive for the entire world. You can see on these next charts that the world supply chains have done okay in terms of volumes when faced with this surge in demand. America has seen significantly more volume through its ports, whatever the narratives that supply chains are not performing, they're actually delivering a huge amount. But that increase in volumes has been accompanied by a big increase in prices, which really is, for the rest of the world, like an external shock. It's as if the supply chains were bunged up by COVID from the perspective of Britain or from the perspective of Europe, because they've been bunged up by an external force that's not related to goods demand here. So the first question for anyone trying to predict where inflation is going is, how soon will the American consumer return to a normal pattern of spending? Because it's that switch back to services from goods that's the number one force that's going to ease the bottlenecks in global supply chains, which you would have read a lot about. And the longer that's delayed, the longer goods prices and the economy is going to behave pretty strangely. But inflation, as the past 2 weeks have made all too clear, is not only about goods bottlenecks. And on this chart, I break down inflation in the euro area, the US, and the UK, going from left to right. The categories don't align exactly because of the different ways the statisticians slice and dice the data. But you can see that the US that had the biggest increase in goods prices, which is the grey bar there. But you can also see that the inflation has spilled over into services prices, and that's the inflation that is now worrying central bankers and is worrying policymakers around the world. The idea that that goods shock is in some sense propagated through the economy. And you can see in the euro area and the UK that while there has been some goods inflation, and that is unusual, it's really energy prices that have been the dominant inflationary force. If you just bear with me while you look at that, I'm going to pour myself some water. Now, it's this energy problem that is obviously about to get a lot worse. The numbers are changing all the time, but since Russia's invasion of Ukraine, natural gas prices in Europe have trebled, and the oil price has surged above $130 per barrel. We're seeing probably the biggest across-the-board commodities price shock since the 1970s. It means inflation is going to go well beyond what central banks thought they were going to have to deal with this year. I called this talk Pricing in Prices, and when I was looking on the Bloomberg terminal last night at what markets think is going to happen to inflation, they were pricing in an additional 2.5 percentage points of consumer price inflation in Europe. That's the change since the invasion, 2.5 percentage points in Europe, and 3.3 percentage points of retail price inflation in Britain over the next year. Now consider that that's already from a high base because the expectations for inflation were already high. So the consumer, and especially the poor consumer, is really going to feel this if those bets are correct and those commodity prices are not coming back down. And governments are going to want to respond to it. But it really puts central bankers who are setting interest rates in a difficult spot. The usual playbook for dealing with higher energy prices is to more or less ignore them because they're supposed to be temporary. Even if oil and gas stay expensive, unless they keep getting more expensive at the same rate that they have over the past 2 or 3 weeks, the effect on inflation will go away because inflation is the change of prices. It's not just things being expensive. So central banks are sort of meant to ignore energy prices or the more subtle language, look through energy prices when they think about how they set interest rates. Britain pulled this off remarkably well in the early 2010s. Inflation went above 5%, The Bank of England didn't respond, it came back down. And then they did it again after the Brexit referendum, inflation went up, the Bank of England didn't respond. In fact, it stimulated more, and inflation came back down because everyone knew it was a one-off shock. There was a strong contrast with what happened in Europe, in the Eurozone, I should say, where the ECB raised interest rates in 2008 and in 2011 in response to these sort of temporary inflation shocks, and that premature monetary tightening made Europe's recovery from the global financial crisis much more slow. But that playbook of looking through the inflation shock, of not overreacting to it, only works if inflation does not take on a momentum of its own. And even before the war, and the big rise we've seen in wheat prices, in metals prices, and in the oil and energy prices recently, there was a danger that we were approaching this sort of self-sustaining inflationary problem in which both workers and firms come to expect high price rises, and as a matter of course, they then put them up each year by more than they were doing previously. And that's what happened after the oil shocks of the 1970s, and that's the dreaded wage price spiral. So it's become increasingly important to look out for signs of that, to look not at headline inflation, but to look at domestic inflationary pressure to see if it's spilling over, to see if inflation is gathering momentum at home. And that basically more or less means looking at the labour market and looking at what workers are getting paid. Now, I can tell you that opinions differ a lot on wage price spirals, on what causes what, on whether inflation expectations matter, but I think you can at least say the following with confidence. If wages are growing faster than your 2% inflation target, plus a reasonable estimate of workers' productivity growth, how much they're making when they're at work, then you are looking at something that's unsustainable. Where are we? Well, in the US, I would say we very clearly breached that on wage growth. As you can see on the left-hand chart here, their wage growth is over 5%. And we're sort of in an intermediate position in the UK, just over 4%. You know, it's looking like the labour market's very hot and may overheat soon. The euro area hasn't shown strong signs of a wage overheat, but that may just be because their data are a little bit lagged. Now, if you're going to tell a story for why we're not going to be in a high inflation world, you need to be able to explain how wages are going to come down. And another thing I'm sure you've read a lot about is the Great Resignation, people leaving the workforce. As I show on the right-hand chart, this is a curiously British and American phenomenon. In lots of countries, in Canada and France, there are actually more people in work aged 15 to 64 than there were before the pandemic. They've more than recovered to their employment rates. But in the US and the UK, people are putting their hopes on the idea that workers are going to return to the workforce, and that will kind of cool everything down. This idea comes with a note of caution. A lot of the exits from the workforce that we've seen during the pandemic have been retirements. It's been people like my mother who told me that all the technological change that took place during the pandemic just wasn't worth the investment learning, given that she was close to retirement age. She's retired earlier than planned and is not coming back, and I do wonder how many of those early retirements are going to be unwound. Even in Britain and America, it's not that much. We're back to sort of 2018 levels of jobs. And in 2018, you may recall, people were celebrating the labour market. It was one of the most important claims of the Conservative government, that they'd been great for domestic jobs, and no one would have been surprised if it turned out that we'd sort of hit the maximum on the labour force before you get into an inflationary scenario. So I don't think we should put too many eggs in that basket. But perhaps a likelier source of cooling the economy and cooling the labour market is going to be if these, energy price spikes are so great that they take so much money out of people's pockets that they push the British economy into a recession in which there are layoffs and the labour market cools down that way. This is possible, and it might even eventually take us back to where we were in the 2010s, where inflation's below target and we're all wondering why. These energy price shocks are really extreme, but it's not going to apply in America, where, if anything, higher energy prices strengthen the labour market by leading to more employment in the shale industry. So we might see a bit more divergence between America and Britain. So I've done one, will the American consumer switch back to spending on services? I've done two, will the workers return to the labour market? And now I'm going to look at the final factor, which is economic policy. This is particularly interesting from a British perspective because our economic policy here has been an outlier over the past year or so. The Bank of England raised interest rates in December, well before the Federal Reserve in America, despite the fact that it wasn't the case that Britain's economy was doing better than America's. And we're also an outlier in terms of fiscal policy because of the tax rises that are soon to come in April, the higher rates of national insurance. And on the left-hand panel here, I show the forecast change in the primary deficit according to the IMF. And as you can see, that big positive orangey line on the right is the fiscal contraction, the shrinking of the deficit that Britain's going to see, and it's bigger than what you've got happening in the Eurozone or in the US. At the same time, we've also had the Bank of England starting the process of reversing quantitative easing, of shrinking its balance sheet, which is not something that's happening elsewhere either. Before Christmas, many people wondered if this tighter stance of monetary policy in the UK was a mistake, if it showed that Britain was going on its own path and it would suffer the consequences of that. But as I said right at the beginning, Britain's actually come to seem somewhat ahead of the curve on inflation because the Fed looks so far behind the curve on inflation in America, and people are really asking, how is the Fed going to correct its mistake here? Pretty much all US economists agree that so long as interest rates remain below 2% in America, the Fed is in effect stimulating the economy. But the argument for why that stimulus is necessary has completely vanished. The UK is in a sort of analogous position, but has already started the tightening. So you could argue it's in a better position. The difficulty is that Britain, unlike America, faces the energy price shock. And if that is so extreme that it damages the economy, perhaps we'll go full circle and think it was a mistake to raise interest rates after all. Sadly, it's becoming really easy to envisage a sort of stagflationary scenario in which pricey energy really damages economic growth, but it also pushes inflation up and starts a wage price spiral. And what's interesting, when I was updating this right-hand chart last night, which shows the expected path of interest rates in various places, what's interesting is that since the invasion of Ukraine, in Britain, that's moved up, it hasn't moved down, which sort of makes sense because the Bank of England is worried about losing the inflation anchor, about self-sustaining inflation. In Europe, which faces a similar problem, it's moved down. People are expecting fewer interest rate increases, and that's because their economy is going to be hit so hard. It's not that Britain's going to escape the hit. We're just in the worst position of having an inflation situation which looks a bit more dicey. If we do get to a world of lost credibility, of runaway inflation, it would require a painful recession to restore credibility, to get things back in control, as it did at the start of the 1980s. Now, I don't think policymakers, central bankers, governments are going to do that anytime soon. It's much more likely that the public is told to tolerate difficult economic circumstances as a consequence of the war in Ukraine. And given the very high degree of popular support for Ukraine among the public, perhaps people will be willing to do that. In fact, the whole credibility of the Western response in terms of sanctions hinges on the idea that Western governments can continue to persuade the public that it's worth paying the price of sanctions to continue to punish Russia for its aggression, and that we can, if you like, hold out longer than they can. They've got a much, much bigger economic problem, but I don't see politicians in the midst of this pushing the economy into a recession to deal with an inflation problem. Instead, I think they'll choose to bear it. The final thing I'll say is that there's a really tricky decision to be made here about government spending and taxation too. Inflation is ultimately a constraint on what governments can do. When the pandemic struck in the spring of 2020, it was low, and so everyone felt really comfortable, in effect, printing loads of money and giving it out. Today's high inflation means that they can't repeat that trick. You can't print money, give it to the poor, and sort of hope for the best to protect them from rocketing energy bills. If we are to increase handouts to support people during this crisis, as I think is both likely and desirable, that increased stimulus, that increased injection of money into the economy is going to have to be met with either higher taxes or higher interest rates. There's no free lunch to be had. So it may therefore be that what we're in for is a period of kind of big deficits in which governments roll out emergency support for households during this energy price squeeze, but tight monetary policy as central banks fight the homegrown inflation. And if we end up with that balance, we'll have sort of reversed the economic policies of the 2010s, which, as you'll remember, were characterized by austerity on one hand, tight budgets, cuts, and so on, but low interest rates and lots of QE. I don't think we're going back to that world. So to recap, inflation's only going in one direction over the next few months and probably a year. But to judge where it's eventually heading, we need to watch the switch from goods to services in the US. We need to watch wage growth everywhere. And we need to watch how economic policy responds to these truly extraordinary times in which the world economy suddenly finds itself. Thank you very much.
Thank you, Henry. Thank you very much. And thank you to everybody who is putting questions onto the system. And I'm going to start off. Some of them I think you've already answered to an extent, but let's just go through. Let's start with the one that's the most popular question. In the light of low levels of unemployment, how will the transmission mechanism from commodities and energy inflation into wage inflation evolve, and how will central banks react to this? I mean, you've answered a lot of that already, but perhaps it's just worth going over some of those again.
Sure. Well, it's a really good question.
Yeah.
And I don't think that economists and central bankers truly have the answer. When I speak to central bankers at the moment, what they tend to tell me is what we're looking for is wage settlements that reflect not just a catch-up, not just making up for the inflation that's happened over the past 12 months, or what you're already seeing in the consumer prices index. What they're looking for is inflation that reflects the expectations of workers that inflation is going to be high going forward. So that's what everyone's really on the lookout for. The question is, can you actually distinguish between those things in real time? It relies on surveys of workers' inflation expectations, which I'm not sure anyone really trusts. I mean, how many of us really go around with an inflation expectation number in their head? I mean, maybe in this room, lots of people actually, but how many of the public really go around with that number in their head? So no doubt that's more likely to happen given that unemployment rates are low and given that labour markets are tight. That's very clear. I think central bankers would be a lot less worried about an energy price shock if unemployment was high. But actually, we have historically tight labour markets everywhere, and that's, you know, it's a great thing for the labour market, but it's a reason to worry about what happens after an energy price shock, especially one that's going to be as bad as this one.
And you used the dreaded word stagflation in your talk, but again, how do you think policymakers can deal with stagflation? How can they offset some of the sort of ghastly impact of it?
Well, I think that it's very difficult to avoid the hit to living standards that comes during a period of stagflation. You know, the logic is sort of inexorable. It's not that there's not enough money in the economy and you can just sort of pump things up a bit. It's that higher energy prices are making your economy poorer. You can't fundamentally get around that. I think it would be a mistake for central banks to get ahead of themselves worrying about a wage price spiral until they've got firm evidence. So I don't think they should push the economy into recession while the energy price shock is still what's driving the inflation figures. Perhaps that will be needed later on to deal with the inflation problem, but I wouldn't do it immediately. But in terms of policy now, I think the only thing you can do is focus on the distributional elements of that and say, well, who's actually hurting the most as a result of what's going on in the economy, and can we make that less painful for people on low incomes? And that's pretty much all you can do. You can't get around the fact that expensive energy is going to reduce your economic output. There is a question, I think, of whether we resort, if things get really bad, and I think this would require Europe to follow the lead of Britain and the US in imposing an oil embargo on Russia. But if things get really bad and oil prices go towards $200, say, which is what the people I speak to suspect might be possible in that case, then I think we have to look at things like perhaps some rationing schemes, perhaps reducing speed limits on the road, this sort of stuff that, you know, no one's thought about in 50 years, but suddenly is going to become part of what is, in effect, a war effort, even if Britain is not a participant in the war.
And just following on from that, what's the lead time on commodity price, from the commodity price spike to the actual inflation number?
That's a good question, and I'm sure there are people who have answered that more precisely than I can. It's pretty quickly the direct effect of fuel prices and energy prices in the consumer price index. You're going to see that, you know, over the next couple of months. The question is the knock-on effects as firms' costs go up and they get passed through. If firms are taking time to pass those costs on, then it will be a slower process. But like I said, I'm sure there's a precise answer for that out there, which I could dig up and bring back to you.
Well, exactly, and which will probably be evident after this crisis is over.
Quite.
And just one final question which popped up on the screen, which I quite liked, is should Rishi Sunak drop the national insurance increase from a policy perspective?
Another good one. So I think the national insurance increase is pretty bad policy. I am biased here as a young person. The gap now between what an average earner who is of working age and receiving earnings is paying in marginal taxes, which if you include employers' national insurance and if you include student loans repayments, which are in effect a graduate tax, that rate is now something like 50% or just shy of 50%, even on a £30,000 salary, the total tax wedge there. For someone receiving pension income, it's just the basic rate of tax, it's 20%. That gap, I think, is an injustice, and it's something that young people feel very, very keenly. So for that reason, I think the national insurance increase is bad. I don't think that the general point about raising taxes at this moment is bad. I think that if you've got big spending commitments, as Britain does, you need to pay for them. It's not the moment to be blowing up the deficit and stimulating the economy in a moment of high inflation and a big energy price shock. As I said at the end of my talk, you're going to have to meet whatever you do with some offsetting tightening, and tax rises are part of that. So I'd say it's not a mistake from a macro perspective, but from a micro perspective, I think it's a very unfair policy.
Yeah. And on that note, Henry.
End with a win.
Well, I could hear how passionate you were about it, which was fantastic. But thank you so much. I think you've given us some really good food for thought. I think, as we all said at the beginning of this, we are living in really uncertain times. Things are really happening in real time. And economists and policymakers are having to react to that. And you've given us some very good ideas about how that might play out in the next few weeks and months. So thank you very much indeed. And now, ladies and gentlemen, we're going to take, as they say, a short break. I think we have to be back here at, I'll just tell you what the time is, at 3:30. There's tea, coffee, cake, and other delicious things outside. So I look forward to seeing you back here at 3:30. Many thanks. Henry, thank you so much.